Welcome, friends, to one of the first assignments in this class. This is a financial health assessment. We want to know where we are at any given time and if we were actually paying for the services of a certified financial planner. One of the first things they ask you to do is a financial health assessment. So we can do our own. And here's how it goes. So basically, what we're going to look at is a snapshot of our individual standing, assets to liabilities. We're going to look at net worth. If you have taken an accounting 2301 course, and you do not have to have that course to take this, but if you have, you've heard of something called the general accounting equation, which all businesses have to have. It's owner's equity equals assets minus liabilities. That's just the worth of the company, just asset value. Well, same thing for us. Our net worth is what we own minus what we owe, and it gives us a healthy reading, hopefully. So we also look at our debt to equity ratio, and that is, again, how much debt do I have compared to my assets, the leverage that I hold financially, and also my debt to income payments. We may have a very healthy income, but if we have a lot of debt that we are servicing, those numbers look very interesting. So here's how we do the first thing. First thing you need to do is download that. So download this template. This template is a blank template. It's for you. I would keep it. And as soon as you download it, I would open it and then save as Financial Health Assessment Project with your name in it. All right, I would do mine as Randy Saleh, and that's how you're going to upload it back to me. So that's the first thing we do. I'm going to show you how all that works out. Basically, as you analyze these metrics, you really have a better snapshot. Hey, it may not look pretty the first time, and generally speaking, it does not for most American families. Again, we're looking at that 70% of American families, very, very, very hard time, so to speak, in financial peace and financial literacy. So what we're going to do is figure this stuff out. Now, you are more than welcome, please listen carefully, to use your own financial information if you would like to. Now, you do need to have some sizable assets to get this thing done. And if I'm in high school or if I'm just in college and I'm living at home, I just don't have the assets to make this project worthwhile, so to speak. And so we're going to use ourselves as a consultant. You're consulting someone right here, and this is who they are. They have a family income of $140,000 a year. All right, that's good, nice, healthy income. Good professional jobs, after pay and taxes and their benefits. They have $8,250 a month of cash flow coming into their bank accounts. Hey, that sounds great. All right, they're 43 years old. They have two children, aged 13 and 15. Well, as you know, 13 and 15-year-olds are going to start costing quite a bit of money. So we need to take a financial assessment of them. And I have given you all the information that you're going to need right here. Now, if you're close to fitting that financial look right there and want to do your own, or if you want to do your parents' or your family's income, that's perfectly fine. And if you don't want to, that's why I have the numbers right in here. But again, if I don't have any assets, then the assignment won't mean a whole lot. So in this case scenario, they have a home of $325,000. That's the worth of it. They have cars at $45,000, bank accounts, retirement account. So these are the assets, which we would always want to do, look at our assets. And these are our liabilities right in here. We have mortgage, we have car loans, bank loans, student loans, department store credit cards. Pretty easy example here. Now these are their monthly payments. So with all that information, we can now look at how to actually do a financial health assessment. So once you've downloaded the files I've given you, this is what your template's going to look like. So you can put in the value of a house, and the way I have it, hopefully it's going to do some calculations for you. Not all the calculations, but let's say $325,000, it should populate right there. And if we had a mortgage of $300,000, then we would automatically start looking at a little bit of a net worth, which would be right at $25,000. So as we put these numbers in, they're going to calculate for us, trying to make it easy as possible. Again, for those that have some friends, or certainly a lot of students are still living at home with their parents, it's an eye-opener. It's an eye-opener that you may want to help your parents out, or help some people out, or certainly help yourself out if you're in a situation. Many students who take the class have been in their career quite a while. It's a great way to say where I stand. This is going to be the debt to equity ratio. We will have to put some numbers in here. So my friends, what I've done is made a quick financial health assessment on a fictionary person. Okay, let's just say they're a recent college graduate. They've at least been in the workforce going on 7-8 years. They're in their young 30s. All right, they purchased a house a while ago, and now it's worth $350,000. Excellent. They have a car that's worth $25,000. So we find what our assets are, and we put them on this side. They have a retirement account of $50,000. Very good. They have some investments at $15,000. Certainly an asset. Excellent. A little bit of art that they purchased over the years from some art gallery, and we'll put that at $6,000. Again, we're getting our best guess on some of these. We know direct amounts in bank accounts and retirement investments are a little bit arbitrary, but we'll go on evaluation of appraisal. And then electronics, well, we have phones, we have TVs, we have computers, we have a lot of stuff, and we're giving our best guess on that. Unfortunately, for electronics and items like clothes and cars, they are depreciating, and so we're giving our best guess. We may have spent a lot of money on our clothes and our electronics, but what could we get them at a resale shop for? Let's just say 5 and 5. Gives us a total assets of $471,000. That's like a nice number. Of course, with assets generally come debt. And so we have liabilities. On our house, our liability is our mortgage. So we may have paid $300,000 for it. We've paid down we paid it $30,000 down, so our mortgage is now $270,000, and the house has appreciated. You could find that on any realtor's website. You can basically look up your house and see what the going value would be, or a tax assessment from the tax assessor. So that's good. A little bit of a car loan there, so that means we do have a relatively new car. We just put a lot down on it. Excellent. We have a bank loan, let's just say, of $5,000. They have a student loan of $25,000 and credit cards with a $2,500. Not bad at all, really. And so we have $471,000. Again, hopefully these will add up for you in what I have given you in the template. Total of $312,500 worth of liabilities. So assets minus liabilities equals your total net worth. So this person has a net worth of $158,000. It's a positive number. If you are going to, sometimes you may want to do this for somebody else. It will show up as a red number. Anything in the red is a negative number. Can you get negative numbers here in life? Yes, you can. Usually when you just have much more debts than you have assets. All we're trying to do is find our snapshot of our wealth. Gives us something to build upon. So what else do we do here? Now we're going to go into our debt to equity ratio. This is our total liabilities by our net worth. Now when I get these numbers, we're not including the home value, and we're not including the mortgage. That's going to be asset-based lending, and lending that that's an asset right in there. We want to get what we're having, of consumer debt, and we never ever. We can't have that number over 1, as you're going to find out. That means every dime we would have is going to a payment, and we'd be broke. We don't want to go over 80%. That's a bad warning sign. So let's look what we have. Our total liabilities minus the mortgage is $42,500. Our total net worth minus the home value is $121,000. So that gives us, this person right in here, a debt to equity ratio of 35%. So yes, it's under 80. That's still a high number. So as good as we were looking on this page up here, and it was looking pretty good, That's still a relatively high number, my friends, because we did not include the mortgage. A mortgage on a $270,000 note's probably $2,100, anywhere from $1,700 to $2,100 a month. Of course, that's looking at tax, title, and and insurance and payment. So that would be another 35% of our income, going to that. And then we have to eat, and we have other things we have to do. So this at least gives us a number that we can look at, and we would like to get that lower. All right. All right. Now we go into, now on those numbers right in here, we had to input those. You have to input, so you're going to have to take the liabilities yourself, take that number minus your mortgage. So we're taking the 312 minus the 1270. We're taking the assets of 471 minus the 350. So those are going to be numbers, and it will automatically, once you put these two in, it will automatically get you that number right in here. Same down here. All right, now we have monthly debt payments. So when we look at the student loans, the car payments, again, we are not including the house payment here. So we're just including the consumer debt we have: car loans, bank loans, credit cards, student debt, and our net monthly income. Now this person was making $100,000 a year. Once we take out benefits and taxes, which is about 30%, the take-home pay by month is $5,800, which is a nice amount. So we divide always our debts by our income. And this tells us right in here that, all right, our consumer credit, we do not want to exceed a maximum of 20% of our after-tax income. And we're almost at 23%. Okay, again, it's an assessment to tell us what we need to do to improve here. So even though we have a very good income, we do have some sizable debts, and so 23% is going for consumer debt. Again, we're probably going to have another 25% or more going into, maybe 30% going into our mortgage payments. So we're over 54, 55, 50, maybe even 60%. And now we have to live, we have to eat, we have to do other things. Yeah, that's why a lot of people don't want to do this. So the little financial summary right in here, we have $158,000 worth of net worth. There we go, we found that out. We have 35% of our debt to equity, and then we have 22, rounded down on that, of our income, debt payments to income ratio. Now we would want to do, in your assignment, a little something extra. So once again, here is our financial health summary. As we've looked at, we have a net worth, we have equity ratio, debt to equity, we have debt payments to income. So the final part will be right here. Now that you have these numbers, you can go right into here, here, and here, and you will be able to type in suggestions. This is the strategy. So at least 250 words as a total for all three. So what is that? Basically 100 words an area here, my friends. How could we increase net worth? What are some strategies to do that? What are strategies to reduce debt to equity ratio? And of course, what would strategies be to reduce debt payments to income ratio? Now these are things we're going to be talking about through the course, but right off the top of your head, friends, you're going to, when you're finished with that, you will save it. Again, save it with your name. What I would also do is just keep one template blank. That way you can help out yourself later on in life. You'll always have this, and you'll have some ideas of, again, how to help someone else and where you can work on a snapshot. We will only improve upon what we measure in life. That's just a real axiom there. So I hope this will help you. Now, what do we do when we're ready to go back and submit an assignment? Again, I hope you have been able to had a course before, but if you've never submitted an uploadable assignment on Canvas, let me quickly go to the view this as a student. Here we go. So when you're ready, you start the assignment and you upload your file. You simply upload that, choose your file right in here. As I would choose this file, I'm going to go back to my iCloud Drive. I'm going to go look at that. Again, hopefully you have good storage management on all your classes, and then you just find your projects there, and there is mine right in here. Open it, boom, submit assignment. You should have a little yay, I submitted my assignment. Here's the great thing, you can always look at that assignment and go, oh no, I didn't do the right one. You can do a new attempt. You have unlimited attempts, and it will always record or submit the final assessment that you have. There it is, it's worth 40 points. You'll have your due date. Again, your semester and year may be just a little bit different, but get that in and get you 40 points, and we'll see again, get a good assessment rolling. Hope you enjoyed it. All the best.